Hello, everybody, and welcome to today's videos. Today, I want to talk about Teledoc. So, Teledoc was a Wall Street darling back in 2020, and the stock had amazing performance, amazing growth back in 2020 for obvious reasons because we do telehealth. And I bought the stock. I bought the stock not nearly near the highs, but I did buy the stock, and that was a good thing to do, but the bad thing to do is that I didn't sell the stock. And now I am stuck with a loss with Teladoc because I didn't sell it. I do believe in the disruption of healthcare. I believe in telehealth. I think this will be the future. But many of us, when we invested in 2020 in Teledoc, I think we believed that this future would come sooner. And the truth is that the disruption of healthcare, Teladoc has been at it for 2 decades. They've been doing this Teledoc. It started as a phone service. They've been doing it for 2 decades, and we probably have another decade or 2 decades to go. So the long-term thesis, I think, for this company is still sound, but it's going to be a slow-growing company, and it's really not the type of company I want to be in. I want to be in a quick growth company. So I'll just walk through my usual analysis of a growth stock and answer the question: Is Teladoc a good investment? And kind of tell you what I'm doing with the stock and my views on the stock. So, like I said, the company is 20 years old. Started with a phone service, but they've greatly expanded since then. And their mission is to empower all people everywhere to live their healthiest lives by transforming their healthcare experience. And their general idea here is that anybody can go to Teledoc if their healthcare provider provides Teledoc as part of their service. Their health insurance provides Teledoc, and then Teledoc can serve as a way to do just about everything. It's a whole person's care, as they call it. You can do just about everything from Teledoc, and they have like a tiered system which depending on what you want, you may be referred to either online services, primary care provider, coaches, specialists. And so when you get into contact with Teladoc, they kind of match you with either a behavioral nudge to tell you to do something and change your behavior and do better, or with a self-service system, or with digital therapeutics. And if you look at this chart, it's pretty complicated, but it really explains kind of the path that Teladoc expects to serve in a whole person care. And healthcare is a mess. It's pretty complicated, and that's also one of the things that when I assess all of these companies together, is I need to remove points for healthcare and be underweight healthcare because I am not a healthcare professional, so I can't understand that industry as well because I'm not an insider. But overall, the grand concepts of the industry, I think I have a good grasp on. How do they make money, right? So Teladoc makes money by having healthcare systems, insurance systems subscribe to their services, and that's most of their revenue. Most of their revenue comes with the access fee revenue that these big insurance companies pay to Teladoc for services. And 31% of insured people in the US have access to a Teladoc product through these insurance. So again, it's a long range, long term business of negotiation and relationships with the insurance and with the healthcare system. So they do clearly have a moat because it took them quite a long while to develop all of this. And the total addressable market is very big at 261 billion. They haven't even begun to capture, but again, it's the company is going back to its historical growth, and it seems to be a slow growth company now. They have this very interesting idea of a digital front door where you can enter through many of the different services that are provided by your insurance, and then you realize that you can do just about everything from your phone, and you don't need to really go into a medical office building anymore, aside from x-rays and things like that, but you can do a whole person care really with the app. So again, telehealth, I think, is the future, is the disruption of healthcare, but it's going to take a while to disrupt that. Also, let's remember that most people who have strong healthcare needs tend to be older people, and so you're not as technology oriented, which is I think one of the headwinds of the stock. I would have never bought this stock if it were not for the insane growth rates that we saw during 2020. Um, but unfortunately, these growth rates have went back to the usual growth rate of that company, which is not the type of investing that I do. So again, company is back to slow growth, and they grew 3% between Q2 and Q3. So if you analyze that, that's 13.5% revenue growth. Yeah, that's nothing to get me enticed. That's less than monetary inflation. And year-over-year growth has been 17%. So we are back to their usual growth. If you look at the long-term history of this company, they've been growing at about this rate. I mean, which is nice. Like many companies don't have this level of growth, but growth has been decelerating from 2020. From 2020. If you look at the longer term of the company, that's their usual growth. They just had like a really, really, really good 2020 and 2021, and now they're just going back to normal. And why is that? Right? Why is growth so slow? Well, okay, so Amazon, once again, here, just like my video for HIMS, they're saying they're getting into that sector, doing a bunch of stuff we don't know, but there's just so much competition. There's a lot of competition, and you're typically going to go with a telehealth service that your insurance provides for you. There's so much competition actually that I decided to include this chart. If you want to pause the video, it shows you all of the competition and what they do, and what are the pluses or cons. But essentially, if you have insurance, in general, it's zero. If you don't have insurance, in the case of Teladoc, it's $75 to see a doctor. Um, but it really all depends, and most of the customers that go with Teladoc have insurance, as shown by the excess fees that they get from their insurance. And again, the company, the number of visits, etc. I mean, it's growing a little bit, but it's pretty flat. It's pretty flat. So not a catastrophe. Like this company is not going bankrupt. This company is not going anywhere. The stock price is down 91%. The market is absolutely crazy. Like this company is just as good as your average company in the S&P 500, just as good. It's just that it's not growing as fast as it used to, and so it's kind of like you can't win all of the stocks. You can't win them all. Growth runway is 261 billion. They've captured 1.1%. So again, always take these with a grain of salt. But yes, healthcare is huge, and there is a huge total addressable market, and they can easily grow that. But it's going to take some time. Company is also international, which is very interesting. Yeah, they have operations in Europe, in Canada, and that's one of the perks of having been in business for 20 years, is you can really think about building a business with a moat, with good integration with a health system, with data collection. It's one of the big advantages of being an older business. His revenue growth healthy? Well, no. If you follow this stock, you've probably been very upset about the Livongo acquisition, which they paid both in shares and in cash, and they clearly overpaid for it by a lot, and they took a 6.6 billion impairment charge, and so the stock is so down. The question is, are the algorithms selling that stock really digging into the impairment, really making the difference between GAAP and non-GAAP? I mean, I don't know that they do. I don't know that they do. The only reason why I put this, I mean, it's a catastrophic acquisition. They totally overpaid. The only reason why I put it as medium here is because they paid with an overly inflated stock. Like they paid with a very expensive, much of it with a very expensive stock. and it's not as bad. But in principle, I don't like that they acquired Livongo because uh, Livongo is a mental health and it's growing faster than say primary care visits in the telehealth space. So mental health is growing much faster. Um, couldn't you build your own product for mental health? Like why did you have to go acquire it? Why acquire it? Why wouldn't you build in-house? It's often easy for a business to just acquire and overpay, while strategic attention, CEO attention should focus on building a system in-house. They could have built a Livongo of their own in-house, or maybe they could not have. But what that signals when they do an acquisition like that is that they didn't grow it in-house. And so I typically don't like to seeing too much acquisition. And again, I don't like even marketing expenses. I actually believe that company could be doing much better financially if they spent less on marketing. They spend a lot on marketing, so I don't know what they're trying to negotiate. I don't know how much all this costs. Like I said, I'm not an insider of the industry, but it seems really high for a company that should have tremendous brand awareness after being around 20 years. 30% of revenue spent in marketing is a lot. Uh, and again, I am an outsider of this field, but my little experience in investing tells me that current growth does not justify spending this much on marketing, and so I'd like to see that go down. But again, nothing too alarming. Not investment advice, but I don't think this company is going bankrupt. This company is going to be just fine. It's just going to be a slow grower. A slow grower, so they have free cash flow, right? No risk of bankruptcy, 200 million free cash flow, 900 million of cash, so everything's fine here. Um, and if I look at the gross margin, if I look at the over metrics, gross margin is high, is very high. Not as high as companies like HIMS, for example, which is very interesting. It has you wonder how lean they are compared to the newer telehealth businesses. But the growth, so for the next 4 quarters, assuming their sluggish growth of 13%, that would give us a forward gross profit of 1795. And if you do a price to forward gross profit, you're at a 263. I mean, this is ridiculously low. This is just, the market is just ridiculous. I mean, it has overshot to the upside on Teladoc, definitely, but then it overshot to the downside. Very, very much so. I mean, this is a company that has a moat. This is a company that has very, very low debt. This is a company that has negotiated exposure to 90 million Americans. And they only trade at 2x sales. I mean, they're still growing 13%. That's higher than the S&P 500. So the price is just absolutely ridiculous. Everybody seems to really, really, really hate this company. I usually don't look at price. I usually always look at revenue growth, and I would not be interested in buying this company in the first place if I saw the revenue growth. That's it wouldn't even be on my radar. So that's why I'm kind of in a tough situation now because I bought this stock when it made a bunch of sense to buy the stock because revenue was growing at almost 100%. So it made a bunch of sense. And of course, revenue growth stalled, came to a halt, and now I'm stuck with a stock that I didn't really want to invest in. But then again, if you go back to 2020, uh, uh, you could have made a really strong case that healthcare is moving to telehealth. I mean, even Apple in 2019, so before all of this happened, was saying that telehealth is going to be the biggest thing and that Apple's biggest contribution. Anyways, it's just a slow sector. It's just going to be a slow disruption. And I also don't want to dismiss the fact that, we could not be at the beginning of that S curve. Like that S curve will happen someday. Adoption may be exponential. You just don't know when adoption of telehealth is going to begin that exponentiality. Is adoption of telehealth, like widespread, really, really quickly adoption of telehealth, is that 3 years from now, 5 years from now, 10 years from now? I don't have enough clarity to know, which is why I do not I'm not buying any more of this stock. I am not touching the stock anymore. Dilution is fine aside from the Livongo acquisition. We've discussed that. That's the acquisition you can see right there. And insider ownership is terrible. 1%. Oof, that's so bad. That is so bad. And the business is not founder led. Again, it's an older business, so I could excuse that. But the 1% really is, no, that's really bad. You want much more than that. And the revenue per employee is okay at 454,000 per employee. It's okay. It's much better than a bunch of firms in the S&P 500. Much better. And so will it beat the denominator? I'm afraid I don't think so. So that's why I'm going to focus on what I'm doing here. And if you own this stock, perhaps you might find this useful. So what am I doing? Well, the stock is down. Uh, it went back up a little bit, so it's down 90% from its all-time high. Uh, so it's absolutely ridiculous that within a span of a year and a half, a stock could do 10x one way and then be divided by 10. But really, we expected. I mean, really, I got it wrong. That's why you should diversify. You should always diversify because I totally got it wrong. Um, but I do think the market is way too negative right now. The market overshot to the downside because the stock is back at its 2019 growth. And remember, in 2019, the stock was trading between 65 and 80 in 2019. Okay, I could account for a little bit of dilution, but I'm not going to because the company is much bigger and better than in 2019. They gained so much market share. So many people have tried telehealth. It's a much bigger, much better company now. So even though they had dilution, I easily believe that the stock could be trading between 65 and 80 as soon as this ridiculous market stops being so short-sighted and so short-term oriented. Uh, uh, I believe this company will trend back to its mean to its sluggish, slightly better than the S&P 500 growth. And again, yeah. So that's what we're gonna get with this company. Probably medium to slow growth, and slowly transforming the world of healthcare. And some could argue actually that's probably for the better to not go too fast because this is you're dealing with people's lives, so maybe it's important to not go so fast. Who knows? We may get a positive surprise in this quarter. Of the last conference call, I perused few, and the management was pretty upbeat, pretty positive about what could come next. So maybe 20%, but that still doesn't cut it for me because I want 30% at least. So, anyways, I own the stock. I'm down quite a bit, but contrary to some other stocks, I will not be taking a loss on this one. I'm just waiting for valuation to normalize, for valuation to get back into that long. I'm trying to draw it here, and you can see to get back into that longer term trend. Like that, I'm trying for valuation to get back to a normal trend, to a normal P, not P, but the number of prices sells that it's traded at. And when it gets back to trend, when it gets back to a more reasonable spot, I will be selling the stock, and I will be buying a much faster growing company. But anyways, not a catastrophe. The company is not going bankrupt. But I think it's going to perform in line with the S&P 500, which is not good enough. Uh, not good enough for the stocks that we look on this channel, and not good enough for the type of investment that I look for. So I'm not going to talk about the value of US dollar in 10 years. This is not going to beat the denominator, I don't think. This is not going to exceed 15% a year returns. So anyways, thank you so much for watching. None of this has been investment advice. This is just entertainment and entertainment. I mean, it's not really entertaining to talk about losing money here for me, but it's just the way it is. You win on some and you lose on others. Don't forget to like and subscribe if you can. I appreciate it. And please follow me at Beat the Denominator on Twitter, BT Denominator. I have occasional threads and post every new video on there to get notified. So thank you so much for watching my video and have a great day.